Okay, we're going to talk about something that we've been riffing on off and on for a little bit, especially around the time that Slack didn't go public per se, but started to trade publicly, which is direct listings. And we now know, unsurprisingly to some degree, that Airbnb is going to pursue a direct listing. So first of all, Charles, impressions about that. Like, do you think it's the smart move? Like, what do you feel about that idea?
I do. I'm surprised. It's one of those, this feels like one of those cases where things change really quickly all of a sudden. And I think this momentum around direct list, I remember when Spotify and people said, all the arguments that I think were compelling before I find less compelling. Oh, you can only do this if you're a brand that people recognize. I don't know if I buy that argument anymore. And I'm surprised. It seems to have awoken a set of my peers in venture who have lots of IPOs and deal with this problem on a regular basis to become really agitated and motivated about this sort of IPO pop phenomenon. And finance, I think, is usually a very conservative industry.
Very.
And I think there's just been this awakening both on the side of like investors and on founders that like the old way of doing this doesn't serve companies very well.
Did you go to the conference this week that Bill Gurley and friends?
I did not go, but I followed it on Twitter, and I had some friends who went, and there was a lot of energy and enthusiasm in that room from what I heard.
Yeah, so I talked to Megan Quinn, who went, and I asked her how it was, and she was just kind of like, oh, it was exactly how you would have imagined it to be, and I was like, I don't really know what it was like. But Bill Gurley was kind of the one who, seems like he was the one who sort of threw it together. Had a lot of people there, and it seemed like it's interesting to see how much this conversation has developed so quickly this last few months, because when Spotify did this, it certainly was not, the conversations were not like this, and there were not, VCs preaching about how this is the future. It seems like this has been the summer of direct listings and sort of preaching about the possibility and impact that they can have.
So here's my thought about the narrative that was being built, because there were a number of IPOs this year that priced maybe even higher than we expected them to, and then saw an immediately strong return, which prompted cries of money left on the table. We've also seen the other side of that with Smile Direct Club and Peloton, which priced very, very aggressively, you might say, generating a lot of capital in for their business, and then saw their share prices decline. The other side of this. It's almost as if the direct listing furor is more an argument against overly conservative pricing, as opposed to saying that the IPO mechanic itself is broken, more that the implementation thereof is bad, and therefore it's the banker's fault, which I will never say no to. But to me, it might be the wrong solution, perhaps.
I just try to take myself back. I remember when Google did their IPO, everyone's like, oh, the old IPO process is broken. We're ushering in a whole, and it didn't.
Have you ever heard about another reverse Dutch auction since Google's? No, I had to learn that for Google, and I've never forgotten it. But I can't recall anyone else trying to do that ever again.
Well, I just want to give a brief rant, but I feel like a lot of the there is some criticism over how the press covers IPOs, and it's like I think VCs get frustrated when we cover pops and we make it seem like those are a positive marketing event, and I don't think that that's what we're doing. I mean, I'm biased because I'm a reporter, but I think we cover pops because they are a news event, and I don't think, at least in my coverage of pops, I'm saying, oh my gosh, this company is going to succeed. Wall Street loves them. I mean, we're covering it. How do you do that too? And you also cover pops, and you also cover the opposite.
Yeah, but I cover extreme price movements in the value of newly public companies.
Right.
They reflect what we can learn about the private market. If a company went public a week ago and now it goes up 30% in one day, I'm going to notice.
I also think like we've never in recent memory had private companies raise this much money and remain private for this long. So it's not surprising to me that we're getting to a period where there's wildly divergent views on these companies between private market investors who by and large can only invest in tech companies. They have a very narrow sliver. So it's easy to see how if you can only sort of eat steak, like you're going to overpay a little bit versus the market, which can sell tech and buy industrials or sell tech and buy financials. And so I hope this is like a good process that kind of starts to rationalize the difference between the way public market investors think about this stuff and the way that private market investors do.
I want to go back to, I forget which guest it was, but I said, you can't raise capital in direct listing. Some companies aren't a good fit for that because they actually need the money. And they said, well, you just raise $100 million in a private round, then do a direct listing and decouple the mechanic. I just want to say that we talk a lot in general about things changing in the macro picture. If the macro picture changes and private dollars become harder to find, traditional IPOs will look better in those moments as an actual fundraising mechanism. And, we'll see. But I wouldn't be surprised if we saw that in the next 3 years. So,
yeah, I mean, there's a lot to unpack, and we'll continue talking about this for months to come. I think this is only going to become a larger conversation in tech, Silicon Valley at large.
Yeah.